Yo, what's up everybody? I am back and I just wanted to make a video on how I would be swing trading the S&P 500 if I wanted to increase my portfolio and use my current savings to work for me. I do have savings, but my savings is going into starting a business and buying land in Bali with my wife, which is where we live right now. So my wife would kill me if I suddenly took it and started investing in the market. So I can't do that. But for the people out there, and for me in the future, this is what I would want to do. There are a few ways for you to invest money if you have a lot of cash. One is you can use somebody who runs a hedge fund, and you don't really know how they're going to perform. Two, if you're an active day trader, active investor, and you have a portfolio of stocks, you could bet on the strongest stock, which is an index called the S&P 500, the /ES, or the index SPY. It follows the 500 strongest companies in America, which is the strongest economy in the world. So you're really just betting on the best potential return. The S&P 500 beats most hedge funds, if not all hedge funds, year over year. It makes over 10% return on average. There is a way to capitalize on the corrective movements the SPY does. So the S&P 500 has indicators specifically made for it, which work like RSIs, like a stochastic. Oversold, overbought. And the one that I'm going to recommend you try out is the SPX A50R. The SPX A50R is the 50-period moving average and all the stocks that are traded under the index SPY that are trading above or below. Okay, so the 50% mark, the 0.5 mark here, is the mean, right? If everything is 100% bought and everybody owns all the shares and there is zero float on all these stocks, then it would go to 100%. It never does that, but it might go as high as 98, right? Which is here. That being said, every year you have quarterly earnings, 4 sets, and the biggest sell-off tends to be before the new year. It happens usually between August and October, sometimes a little later, and that's fine. However, how do we buy the S&P 500 at a bargain price with an almost guaranteed rebound within the shortest period of time, and how can we capitalize on that? There are 2 ways. You buy the stock, SPY, or you can buy LEAP contracts. If you're unfamiliar with options contracts, they have Greeks, so they decay, and there's implied volatility. The SPY has so much volume traded that there's almost never any high implied volatility, which means essentially slippage. Slippage is price is so volatile when you buy, you get placed in at a higher price and you're already effectively down on your investment. Slippage in options is implied volatility. If there's a high implied volatility, like over 40, when you enter the options contract, you will be down 5 to 10% already. If there's a really high IV, like 100%, never trade it. This doesn't happen in the SPY except for maybe during COVID times, so it's not something you have to worry about. If you buy a long-term expiration, like a LEAP contract, it's anything technically over a year. But if you want to get away from decay, I recommend, decay is the expiration date of the options. If you buy an option that expires at the end of the day, if you hold it for 2 hours, that options contract will decay so much it's already almost worth nothing. If you buy an options contract on the SPY and you're expecting the price to go up in 3 months and you have a 3-month expiration, it will lose its value if SPY stays stagnant, okay? You want to buy a contract that's not going to experience decay, and that as long as the SPY does in fact rebound within a 2 or 3 month period, you will have made profit. You want to stay away from decay, so effectively follow my advice, buy something that expires within 6 months. Now, I want to show you how this works. Every red line here that is vertical shows when a sell-off happened. Now, in 2015, in the beginning of August, it went under the indication point, which is 0.2%. Anytime it goes under 0.25 to 0.2%, it tends to rebound. The caveat here, or the exception rather, is COVID. It went to 0.01, which is insane. So it's an anomaly and we shouldn't really count that. Big sell-offs like that tend to happen every decade, so any ending in 0. So you want to be careful, okay? Those tend to be the biggest sell-off days, sell-off years. Anyways, SPX A50R, when it goes under 0.25 or 0.2, you want to look for rebounds. These tend to be bargain prices. The SPY every year seems to sell off about 15% on average. And then it creates a new all-time high. It happens year after year after year after year. Now, for example, okay, August 2015 sells off, goes under the 0.2. So we look for buys. August 2015, it goes from $202 to $181 and then rebounds within 3 months to $213. Okay, that's like a 20% increase in price. I'm not a mathematician, but it's a good increase in price, and it does better here than any other part of that year. Okay, next year, August starts to sell off. All right, what year is this? 2016. So we go to 2016. August surges. August sells off. It goes from 219 to 208. Not that huge, but by the end of the year, it goes up $20. Okay. Next year, same time, August 2017. August 2017 sells off from 250-ish to 240-ish. By the end of the year, by the next year, it closes at $280. Okay, so it goes from 240 to 286 in 4 months. Insane, okay? And it does this every single year, okay? Starts to sell off end of September 2018. September 2018, it's at almost $300. It continues dumping until the end of the year, massive to 230, and within 4 months of it rebounding, it goes right back up $70. So these are really, really big moves. You can just identify them, or you can anticipate that once price is sold off 20, 25%, and the SPX A50R is under 0.2%, you have two things telling you that price has gone to the usual maximum of its sellout point, and you can, one, buy some stock to hedge your potential losses, and you could buy leap contracts. Time and time again, within 4 months, price rebounds, makes new all-time highs, and then continues to surge. And I want to show you a little PowerPoint. It's real quick. And when I advise people to do this, this is essentially what you're looking for. Identifying the probable support area. You want to look at previous order blocks, previous year's highs, and previous year's lows. And you can measure that. It moved 30 points here, and now it's up here. 30 points down. Okay, it's probably a good time to buy. Average recalibration percentage. The market generally drops 10 to 20% max during these sell-offs. Potential options chains and their volatility, and the potential rebound periods, which are usually 3 to 6 months. So here I have an example for you, if this thing will go. Identify options chains within parameters, leap contracts or contracts with almost zero decay. If current SPY price is 570, which it is, it's 571. So we're going to use this. We're going to assume that right now it's December. The SPY has sold off 15 to 20%. We're expecting a 20% rebound. 20% rebound is $685 from the current price. So we buy a 6-month expiration. It's currently end of September. So by end of March, 6 months, we buy the 575 call. It's 1 point out of the money, right? So you have in the money, out of the money. The strike price is 575. The price is $28, okay? Which means $2,800 because it's 100 times the value if you buy an options contract. So you buy we buy 10 March 2025 575 calls. It costs us $28,080. Our price target is $685, and it needs to hit that at least by the time the option expires, preferably sooner. That's the target. The target is a 20% increase from the current value. You're just expecting that it rebounds to where it was before and puts in another higher high. Just a little bit. The same thing it does every single year. So we buy the 575 contracts. It costs us $28,000 to do it. And let's just say in January 21, 4 months from now, January 21st, it hits 685. This, the greener, the better, obviously. So if it hits it tomorrow, it's a 387% return. If it hits it in 3 months, it's still a 306% return. I don't know why more people are doing this. I don't think people know about it. I don't think people really know how to invest, which is sad, but it's besides the point. So if you were to buy the March 21 575 calls right now, if the market had just sold off the yearly 15%, expecting a 20% increase on the SPY price, and you sold in 3 months in January, on January 21st, that $28,000 would be worth $85,000. It's a 300% return. So if you invested 100K, it would be worth 300K. If you invested $1 million, it'd be worth 3 million. If you invested 3, it'd be worth 9. So it's a really, really good return. So let's say you've got $50,000 sitting around and you want to bet on the US economy doing well, and we just went through the yearly sell-off, and you buy $25,000 worth of stock, expecting a $40 to $50 gain per share, which is 20%. And you take your other $25,000 and you buy a LEAP contract with at least a 6-month expiration date just outside the money, with the plan to sell it at once it's had a 20% increase in price. Completely feasible because it does it every single year. And if you were to do this, you would 3x your investment on that $25,000 on the options, and you would have made a 20% increase on the stock you've had. And you could do this year over year over year over year, and you would never lose money, okay? Even if we went into another COVID situation, if you continue to take that same $50,000 and then pocket the profit at the end of the year and maybe live off of that or put it somewhere safe or whatever, and every year you put that 50K in, when we have COVID number 2 and you lose, the $25,000 on your options, you still have that $25,000 worth of stock that's never going out of style because you own the stock. You just have to wait for it to rebound. And if you've been doing this for 5 or 6 or 7 years before this happens, you will have made a shitload of cash anyways. You could take that 50K and turn it into $80, $90, $100,000 every year, take that 50 out, put it out, and then take that same $50,000 next year and do the same thing and keep doing that. You pocket 50K, you put the other 50K that you originally had right back in the market, and rinse and repeat over and over and over and over again. And then someday, maybe you have enough money and you want to do 100K, and you're putting 50K on options and you're doing $50,000 on stock. You will never lose your money unless the US economy ceases to be the leading global power. The US dollar is the standard that is used to buy oil in the Middle East. It is the standard that is measured against NATO. That's why Forex pairs are extremely balanced against the US dollar. They never really change a whole lot. When you look at GBP, JPY, they fluctuate massively. Why is that? It's 2 economies. One is incredibly strong and one is not so strong. And then you have Euro USD. It's 22 countries that trade the euro, okay? And then there's the US dollar. 22 very stable countries that may have variation compared against the strongest economy in the world, okay? You're betting on the strongest index in the strongest economy in the world to continue doing what it's been doing for the last 100 years, and you're just expecting it to continue up 20% after a sell-off. Not 20% in general, it's after a massive sell-off correction. Completely feasible. This is the absolute best way to invest money in the market. You don't need to even diversify a portfolio and have stock. You just need to invest money in the S&P 500. It's so fucking simple. Anybody could do it. Anyways, guys, I hope you enjoyed the video. I know it's long-winded, but this is what I would do if I was going to cash in on my savings. I hope you guys keep watching. And if anybody has videos that they want to see, feel free. And if I have some expertise in the area, I am self-taught. I'm doing pretty well with it. And yeah, I got into this whole thing because I traded with Tim Sykes, and I thought it was really cool that he was taking money from the banks and building schools in Africa. And I thought it would be pretty cool if I could teach myself how to do this, how to take money from the institutions legally in something where there's a 95% failure rate. It's just an absolute win. And then if I could give back to a community. I think financial advice is really hard to come by because it's all based out of like corporate stuff like hedge funds and TD Ameritrade and Charles Schwab and shit like this. And at the end of the day, I don't really know if those guys know what they're doing. They have certificates, but when I call into the broker and talk to them, they're like, "Oh, you trade?" And they have all these questions like, "Yeah, I'm still working on. I don't really know what I'm doing, but you know," I'm like, and these guys are investing people's money. So just take that for what it's worth. Anyways, guys, peace. Thank you so much for watching. And again, if you have any recommendations, please also like and subscribe. I'm definitely trying to grow this channel. I think it'd be pretty cool if I get to, I don't know, like 1,000 subscribers, but it's my 4th video. So anyways, guys, peace out.